Peter Lynch begins this chapter by calling out a long list of popular but dangerous sayings about stock prices. These phrases comfort investors, but they are mostly myths. He groups them mentally as the 12 silliest ideas people repeat, and his aim is simple: help you stop believing them. When you hear yourself saying one of these lines, it is a signal to step back and rethink. One of the most common myths is the idea that if a stock has gone down so much already, it cannot go much lower. Lynch tells the story of Polaroid and of Kaiser Industries to show how foolish that feeling can be. A stock can keep falling long after you tell yourself it has to stop, because price moves are not constrained by neat rules. The market can push a company to absurdly low levels even when, on paper, it seems cheap. That is why "it cannot go much lower" is no reason to buy. Closely related is the belief that you can always tell when a stock has hit bottom. Lynch compares bottom fishing to grabbing a falling knife. The right moment is nearly impossible to pick. A troubled company often vibrates along the bottom for years before recovering. Better reasons to buy a beaten-down stock are improving business conditions, a strong balance sheet, or verifiable evidence that the situation is changing, not simply that the price looks low. On the other side of the coin, people say, if a stock has gone this high already, how can it go higher? Again, Lynch warns this is a poor rule to live by. He points to long-term winners like Philip Morris and some smaller stories, companies that kept rising long after skeptics said the gains must be over. If the story is intact and the earnings keep growing, prices can climb much further than intuition says. Selling just because a stock has already done well often costs you the biggest gains. Another favorite line among casual investors is, "It is only $3 a share, what can I lose?" Lynch is blunt. A share trading at $3 can lose everything just as certainly as a share at $50 can. The absolute price per share tells you nothing about risk. The relevant question is the company's fundamentals, and whether the business can survive adverse conditions. Lynch also demolishes the comforting thought, "they always come back," the belief that every fallen company eventually recovers to its former glory. He lists many industries and companies that never returned: Hastings and Forgotten Fashions, obsolete technologies, bankrupt firms that never reappeared. For every iconic comeback, there are many companies that do not recover. So always comes back is wishful thinking, not analysis.